So, you're curious about trading? Today, we're going to lay out a roadmap, a clear path for anyone looking to get started. But let's get one thing straight right from the get go. Forget all that get rich quick nonsense. We're going to treat trading for what it really is, a complex, skill based world that, if you have the right map, you can actually learn to navigate. Let's dive in. This quote from Swing Trading from A to Z just nails it. Swing trading offers you the prospect of earning income based not on the hours you put in, but on the quality of your trades. That right there is the fundamental shift in mindset you need. It's not about punching a clock. It's about making smart, calculated decisions. So here's our roadmap for today. First, we're going to talk about a totally different way to think about earning money. Then we'll get practical and look at your timeline and the core ideas that'll guide your choices. After that, we'll check out the modern trading arenas, stocks versus crypto. And we'll wrap up with what is, without a doubt, the most important part, your personal battle plan for managing risk. All right, section 1, a different way to earn. This is all about that foundational mindset shift. We're moving beyond the 9 to 5 idea of trading time for a paycheck. In trading, your income is a direct result of the quality of your decisions, period. And this is absolutely crucial. Trading is a business. Let me say that again. It's a business. It is not for gamblers. The source material is crystal clear on this. If you want to succeed, you need responsibility, some serious discipline, and a rock-solid plan. This is a game for the disciplined, not the reckless. Okay, on to our next big decision in section 2, choosing your timeline. Think of this as a major fork in the road. Are you in it for the long haul, like an investor, or are you focused on the here and now, like a short-term trader? Seriously, how you answer this one question is going to shape everything that comes after. This table really breaks it down nicely. So on one end of the spectrum, you've got your buy and hold investor. Think Warren Buffett. They're holding for years, focused on the deep, true value of a company. Then, on the total opposite end, you've got the day trader. They live and breathe the market's noise, making trades that might only last a few minutes or hours. And right there in the middle, kind of that sweet spot, is the swing trader, who's trying to catch price moves over a few days or weeks. Just look at the time commitment. Where do you think you might fit in? All right, section 3, the 2 trading philosophies. So you've picked a timeline. Now you got to figure out how you're going to make your moves. How are you going to decide what to trade? And just as critical, when to pull the trigger? Well, it pretty much boils down to 2 classic ways of thinking. And here's an easy way to remember it. Fundamental analysis is like being a detective. It tells you what to buy by digging into a company's financial health. Technical analysis, on the other hand, is like being a psychologist. It tells you when to buy by reading charts and price data to get a feel for the market's mood. So let's dig into fundamental analysis. You're basically putting on that detective hat. The goal here is to figure out a company's intrinsic value, what it's actually worth, away from all the daily market hype. And that means you're poring over financial statements, looking at the economy. You're really trying to understand the business inside and out. Now, technical analysis comes from a totally different place. The core belief here is that all that fundamental stuff, it's already baked into the price you see on the screen. So technicians look at charts, they look at patterns, they analyze price movement and volume. They're basically reading the market's footprints to guess where it's headed next. But, the real secret is that most successful traders don't just pick one. They often blend them, using fundamentals to find what to trade and then technicals to nail down when to get in. Now, there is a more advanced technique out there called order flow analysis. Don't worry about mastering this right away, but it's good to have on your radar. It's kind of like getting a look under the hood of the market. You're watching the real-time buy and sell orders as they happen to see exactly what forces are pushing the price around. It's a pretty powerful tool for getting a peek behind the curtain. Okay, on to section 4, choosing your arena. You've got your timeline, you've got your philosophy, but where are you actually going to play? For new traders today, this choice isn't so simple anymore. The huge question is, do you start with traditional stocks or do you jump into the wild world of crypto? For the longest time, stocks were just the default. That's where you started. But as one of our sources pointed out, things have changed. New rules in the stock market and the rise of these 24/7 crypto markets have created completely different kinds of opportunities. The big question is, are they actually better for beginners? So let's make the case for stocks first. For starters, they're heavily regulated, which offers a safety net. The concepts are usually a bit easier for total beginners to grasp. And here's a key point, lower leverage. That means you can't borrow as much money, which automatically limits your risk. And honestly, the fixed trading hours can be a good thing. It forces you to step away and gives the day some structure. Now, on the other side of the ring, you've got crypto futures. The biggest perk? The market never sleeps. It's 24/7, which is awesome for flexibility. Then you have leverage, which can be way, way higher. And this is a serious double-edged sword. Yes, you can control a big position with a little bit of money, but your risk just goes through the roof. Crypto is also famous for its crazy volatility, big price swings that create big opportunities, but also big danger. And that brings us to our final and maybe most critical section, section 5, your personal battle plan. This is all about how you manage risk and protect your hard-earned capital. And I mean it, this is the single biggest thing that separates professional traders from gamblers. I absolutely love this analogy from trading expert Alexander Elder. He says your portfolio faces 2 main threats. First, there's the shark bite, that one massive, catastrophic loss that just wipes you out. And then there's death by 1,000 piranha bites, that slow, agonizing bleed from a whole bunch of small, unmanaged losses that just add up over time. So this plan is your defense against both of those threats. Position sizing, deciding exactly how much money to risk on one trade, that's your shark repellent. Setting stop losses, which is basically your automatic eject button on a losing trade, that helps you avoid those piranha bites. And of course, diversification. But finally, and this is the one a lot of beginners forget, knowing when to just get out of the water. Sometimes in a really choppy market, the safest and smartest position you can take is just holding cash. So, there you have it. The map is drawn, the tools have been chosen. You understand the different philosophies, you know the arenas, and you know the risks. The real question is, are you ready to stop just reacting to the market and instead start trading your plan?